Hey, everybody. Jimmy from Joint Ops Properties. I am honored today to welcome a real full-fledged economist onto our little YouTube and Facebook page and everything. And Austrian economics has really influenced how we invest and what we do with our property. And I got to say, Bob, you and Tom Woods through podcasting have basically taught me all this stuff, and I've been able to action on it on how I live like our day-to-day life. So I got to thank you for that.
Oh, well, glad to hear it. I'm glad to be on your show, Jimmy.
So, and anybody curious in economics or not getting bullshitted to, or they hear something in the media and they're like, well, it makes a little bit of sense, but what's the real story? I would recommend going to anything Bob puts out or any of his books and any of his podcasts. So we're excited to have you on, Bob.
Glad to be here.
And you really have taught a meathead about economics.
Yeah, I want to clarify that meathead term is coming from you, not from me. There's no judgment here.
And so the great thing about being buddies with you is that I read something in a book now, and I have, because of Nelson Nash Institute and your guy and Laura Murphy report, I have a direct line to if I read something that I don't understand, and I'm not sure, I'm not offering your services to everybody like that, but at least I can text and be like, what the hell is going on?
Well, right. Yeah, that's so it is because you're part of the IBC practitioner program, and so you're one of our guys, and I'm happy to help you understand what's going on. So you've been reading David Stockman, I see.
Yeah, and this guy's very intelligent. And I can follow him on podcasts, but reading him, I have to go really slow. Mm-hmm. And last week, I read something in the Great Deformation that just infuriated me. And it backed up on what I invest in and how I manage my personal finances.
Well, yeah, just to set the table perhaps for this, we had a similar experience. So Carlos Lara, you may know this, Jimmy, for a while, when I lived in Nashville still, we would have this event that we call the Night of Clarity. And we would bring people, Nelson Nash and Tom Woods and people, and we had a sort of a two-pronged thing. The Friday night would be sort of just an Austrian economics thing, and that where we'd have the big keynote speaker. Like one year it was Ron Paul, and then one year it was David Stockman. And then the Saturday we would tie like an infinite banking concept seminar to it that was, a smaller thing for the people who were into that. And so one year, like I say, David Stockman was our keynote, and he didn't really know the big picture of what we were doing in terms of IBC and how that ties into life insurance, whatever. But on his own, he just went into this very thing you're talking about here, where how the bailout of AIG and how fraudulent it was, because they were scaring the public, making it sound like, oh no, we can't let everyone lose their life insurance when that had nothing to do with life insurance. And so, yeah, a lot of the stuff Stockman said backed up what we were talking about, and it was refreshing because he was clearly coming at it from a different angle. It's not that he knew the stuff we were into, and then he was saying that just to help us. He was just on his own, and he's just a fire hose of information. So it's good stuff.
And I'll be honest with you, since I discovered the Laura Murphy report and infinite banking, insurance contracts and life insurance, it just seems to be popping up everywhere I look. I don't know if it's because I'm looking or that it really is everywhere.
Well, it's funny. I had a similar experience too. I had, as you know, I was an Austrian economist. That's what I was, college professor, whatever. And so I had read Human Action several times. And then only after studying the work of Nelson Nash and realizing how there was this group of people who were using life insurance contracts designed in a certain way, for cash flow management and what have you. Then the next time I read Human Action for a different reason, I was noticing all these passages where Mises was just matter-of-factly talking about how average households save through life insurance. And I had just never noticed that before. So Mises was writing that in 1949, and just stuff like that. I had never noticed it before. So I think it's what you're saying is true, that it's there, but if you haven't been primed to notice it, you just kind of miss it.
And then in my humble opinion, I think it's kind of it is the bedrock of the banking system, because all of their tier one capital is in bank-owned life insurance. But anytime you're actually looking for liquidity, the only liquid assets you can really trust are these contracts.
Yeah, I mean, certainly these things are very safe and, a good source of liquidity. So yeah. I mean, I don't know if I want to, if I'm missing something, but yeah.
People say they have liquidity in their house, right? Because of an appraisal. And so they get a HELOC.
Uh-huh.
And I think appraisals are generally bullshit numbers.
Well, there is that. And it's also funny because when I'm giving a seminar or something and I'm trying to, and I'll show that Exter pyramid of collapsing values. And I'm trying to get people to see how this guy, John Exter, for those who have never heard that term, he worked for the Fed in the 70s, and he came up with this pyramid of collapsing values. And so on the top, there's things like small businesses and gemstones and stuff like that, and real estate. And it just gets down to like T-bills and stuff. And at the bottom, then is currency and then gold. And so I was telling people what he found was that in a panic, people rush to, real liquid assets. And it's funny you mentioned a house, because the way I motivate to get people to see the difference between market value versus liquidity is, like I said, you can have a house that you think is worth $200,000, but that's not very liquid, is it? Whereas, a share of corporate stock might be worth less than that. It might only be worth, $100, but it's extremely liquid that you can have that by the end of the day. Just call your broker. Whereas if your house is, quote, worth $200,000, you can't turn that into $200,000 cash very quickly.
And the house and the stock in a crash, it could go from 200 to 100 like that. But the cash value in your life insurance is always going to be what it's going to be.
We're right. But also even beyond that, so those are related things. But I'm saying even whatever you say the house is worth, that means something different. What you mean when you say your house is worth something, even forget the real estate market, that it's volatile and could crash. Beyond that, though, just you got to market it, or even just going to a bank and getting a home equity loan. There's a process involved. They're going to run your credit, and you can't just. Whereas, like you say, the cash values in a life insurance contract. Not only is that contractually locked in that it can't go down on you, but also you can get the money very quickly. Okay. You just call them up, and they're not going to say, "What are you using it for?" or what's your credit score? What are your sources of income? They don't ask any of that stuff. And again, it's because the nature of the collateral is different.
Right. So let's get into what in the Great Deformation, one, confused me, and two, pissed me off.
Okay.
So he's in this chapter. He's talking about, and I found out about this book because of Tom Woods' book Meltdown. Mm-hmm. But Stockman basically claims that the whole crash was somewhat of a farce created by Wall Street and the big banks so they could get bailed out for their inefficient trading and asset investing.
Well, yeah. I mean, I think more specifically, he's saying there was going to be a crash of those major investment banks or whatever, but people were led to believe the whole world's financial system was in jeopardy. And unless those particular institutions got bailed out, that meant even the little guy, like your bank, wasn't going to work anymore. You wouldn't be able to go to your ATM, or like your life insurance contract would no longer be valid. So yeah, Stockman's claiming that was a complete farce and just a scare tactics to get the public to be okay with bailing out these firms that made stupid investments.
Right. It would have hammered Wall Street, but Main Street would have been kind of going out as a regular business.
Right. That's Stockman's claim.
So he starts out, the panic-stricken Fed and Treasury officials had issued financial ukase, namely that an AIG bankruptcy had to be prevented at all hazards because it would bring the entire financial system tumbling down. Never in the inglorious history of Washington's financial misdeeds had such a large proposition be based on a threadbare predicate. So in Meathead language, he's saying this collapse was kind of bullshit.
Right. Yeah. And just to refresh everybody's memory, in September of 2008, when the financial crisis really hit in and, Lehman's going down or whatever, that the Fed came in with an $85 billion takeover of AIG. So that's the context. And so, yeah, Stockman is saying here that the official justifications for that were completely bogus.
Awesome. Okay, and now he gets into why. And then it's a curious reason why he thinks the economy would have been okay. And it's always something we talk a lot about. So Stockman saying AIG wasn't insolvent. The pretentious young men sitting around Paulson who were unfit for the job and had then seemingly come unglued apparently did not even bother to review AIG's financials. If they had, they would have seen that a mammoth balance sheet resembled nothing so much as a clamshell. The lower half of the shell was comprised of dozens of major insurance subsidiaries and was asset rich with the previously mentioned $800 billion of mostly high quality stocks, bonds, and other investments. They would have also recognized that these liabilities of these insurance subsidiaries were of the slow and sticky variety, consisting mainly of current and future claims of life, property, and casualty policyholders. Mr. Economist, go.
Okay, yeah. So what Stockman's getting at here is that the official, so AIG was in trouble. They need to get, rescued or else they were going to go down. But his point was, or what Stockman's saying is, if you peel it back and look at it, the people think of the average person thought of AIG as the big life insurance company, or let's say insurance more generally, and life insurance was one component of it. And Stockman was saying you had to look more carefully. It was the parent company that was doing all of these risky bets. And I think you've got some quotes later on. We'll get into that more specifically. But in terms of the basic infrastructure of AIG, it was fine. That, these lower things, it was the actual insurance companies that were like the lower subsidiaries, them individually, they were fine because it's not like they had made a bunch of bets on credit default swaps or things like that could fluctuate in value and that were getting hammered because of the collapse of the housing sector and so on, these mortgage-backed securities. But no, in terms of these things, their assets and liabilities, their assets were things that were high-quality stocks and bonds and investments. They hadn't dabbled in these derivative things that were now collapsing. And then on their liability side, they also weren't in trouble. It's not like they had done a bunch of stuff and now we're getting called and all of a sudden owed a bunch of people money that they couldn't come up with. That no, the liabilities they had were very long-term things, like if they had a bunch of outstanding life insurance policies, that were valued at a certain liability because in a life insurance contract, what's the liability there? Well, the person could die, and then when he dies, you owe the beneficiary the death benefit. So if they've got a bunch of outstanding policies, yeah, you can come up with, using actuarial science and assumptions about interest rates and whatever, you can give that a market value to that liability, but it's not like it's going to be due next Tuesday because it's going to be due as those people die. Or if it's, property insurance or whatever, okay, yeah, there's going to be car accidents, and so you're going to get claims. But again, it's not like that's going to spike all of a sudden because there's a financial crisis, that those things are just going to come due. So Stockman's point is the actual underlying insurance carriers, there was no reason they were in trouble in September of 2008. Rather, it was like the parent company had been doing some hanky-panky with credit default swaps or whatever, and they were in trouble.
And then isn't the advantage also of these insurance policies is that they're going to, even in a liquidity crunch, they're still going to bring in cash. You and me are still going to pay our premiums on our life insurance policies that year, and we're still, our home and auto and casualty insurance, we're still going to make our monthly premiums.
Right, yeah. So a life insurance or insurance generally and life insurance in particular, right, they have a much more, their business model is much more stable because you're right that, in a crisis, people might stop going out to restaurants. They're going to stop going to movies. They might not buy that new car and keep driving, their beat up car for another year because the economy's uncertain. They lost their job, but people probably are not going to just drop their life insurance policies.
Or their home and Caterpillar wasn't going to drop all the insurance they have on all their capital equipment.
Sure, right. So yes, that is a business model. Like when you look at what kind of businesses get hit in recessions or not, that insurance companies they're much more robust as opposed to something like, movie theaters or steakhouses or, somebody who's in high-end jewelry retail or something like that.
Or flipping houses.
Yeah.
Okay, so Stockman goes on. Now, this just absolutely shocked me. He's saying that these insurance assets would have prevented a run. And I remember when you and me first started talking about why banking in a life insurance policy is so much superior than banking in a commercial bank is your point was, even in a downturn, insurance policies still bring in cash. Once again, people are still paying their premiums.
Mm-hmm.
So Stockman goes on, unlike bank deposits, these insurance liabilities could not be subject to a panic or a run. Instead, they would come due over years and even decades as eligible loss claims matured. So if they had done even a modicum of homework, they would have recognized that the balance sheet foundation of AIG was stable and was neither exposed to contagion nor a transmitter. And then below here, these are just notes that I made.
Mm-hmm.
We talked about these policies are going to continue to cash flow even in a market downturn. And like I said earlier, and you taught me this, that they're superior savings because there'll never be a run on the cash value of a life insurance policy.
Okay, yeah. So let me clarify there. There is a subtlety which we can talk about, but make sure we just get Stockman's basic point, which is that, block quote above your bullet points there. So yes, what Stockman is saying is these terms like contagion or too big to fail or whatever. What they're trying to say is, we need the Fed and the Treasury need to come in and prop up these big household name institutions, because if they went down, there'd be a domino effect and the whole system would go down. So, for example, like if you're an investment bank and you had issued some credit default swaps and now your counterparties are getting nervous because you issued them on mortgage-backed securities or whatever, and so they're getting nervous and they want you to put up more collateral. This really was happening where these big investment banks could get into trouble where to satisfy these calls for collateral, they might have to sell off some other assets that actually were fine, but they couldn't hold them to maturity. And so now there's a fire sale on these other asset classes, and then their price crashes. And so it was like this vicious spiral where, because they started panic selling in one area, then that all of a sudden ruined the balance sheets of these other companies. So they had to start selling, and it was just this contagion. Okay, so that really, they didn't make that up. That was a real thing. But Stockman's point is that kind of logic did not justify propping up AIG. And he's saying because AIG, all that would have happened is the parent company that issued a bunch of these derivatives or whatever would have been in trouble, but the underlying things would have been fine. In a conventional bank, the reason a bank is vulnerable to a run is because of fractional reserve banking, that its customers think they have short-term deposits, like, hey, my money's there. I gave the bank $1,000. I can get it whenever I want. And then if the bank goes and lends 900 of that out to somebody's, through a mortgage or something, if the customer shows up and says, give me my 1,000, the bank doesn't have it because there's a maturity mismatch. And what Stockman is saying is the normal business model of these insurance companies is they try to engage in maturity matching, that they match the liabilities to the assets, and they know, within the actuarial science, how these claims are going to hit over time, and so they buy assets accordingly to try to space out that risk and whatever. And so that's what he's getting at there. So I do want to clarify. I mean, there is something analogous to this in the life insurance sector, where if everybody showed up and wanted to take out all their money through policy loans, and that was more than the incoming premium payments, then the insurance company could be in a jam there. But in general, that has happened very rarely, and we just know empirically, like in the 1930s, thousands of commercial banks went down, but the life insurance sector was fine, and people even whose savings disappeared in the bank would go to the life insurer and say, hey, can we take out policy loans? And so that's what happened. The public, the life insurance sector it's just historically has been much more solid in this kind of a panic situation.
It's just not part of the Wall Street casino, which is, I think, the main liability that Stockman's talking about.
Mm-hmm.
Okay, so then he goes on to say these policies would have stopped the panic, but AIG could not extract cash or capital from any of these insurance subsidiaries without complying with state insurance commissions rules designed to protect the policyholders. So here's a question I have. When you were talking about when there's a run on a bank and the commercial banks are panicking and liquidating assets at below market values, let's say AIG wanted to start liquidating all these policies. Essentially, they are unable to do that, right, because of state regulations?
Yeah. So, you're kind of combining two things there. So what I was saying before is with the contagion, it was like these investment banks. So the things that own, not like depository institutions, but just things that are, investing in various assets, that they were in trouble, that if their counterparties were asking for collateral, they had to sell off stuff, without holding it to maturity. And so that was causing it. And then a separate thing is like the commercial banks, if people just show up and want their money, like a literal run on the bank, then they're in trouble because of the maturity mismatch. So what Stockman is saying here is that one might have been concerned and said, well, wait a minute, if the parent AIG company is in trouble, and they were because they had issued all these credit default swaps and whatever, then couldn't they have raided these subsidiary, asset-rich insurance companies? And so isn't that the concern?
Right.
And Stockman is saying, no, they were legally prevented from doing that because the insurance is regulated at the state level, and there's all kinds of strict rules governing, the disposition of those assets and what have you. So it just the answer is no. The parent company could not have raided those subsidiary companies. That they were sort of segregated in terms of the regulatory framework.
Okay, and this next part is very interesting to me. Hank Paulson was running around Washington with his hair on fire, but contrary to the message he repeated over and over to purposely petrify congressmen, his true mission was not to save middle American annuitants and retirees. They were already being protected by insurance regulators from Connecticut to California. Instead, this alleged threat of millions of policyholders was a beard behind which stood the handful of giant financial institutions which had purchased what amounted to the wagering insurance from the AIG holding company. So the question I have is, I remember in '08, they were claiming we have to do this also to protect all the retirees and their 401ks and qualified plans, right?
Mm-hmm.
But essentially, because life insurance regulations is decentralized, any retiree who had stored their capital inside life insurance was going to be fine. Was going to be safe.
Right. And also, not just people who had life insurance, but people who had annuities that were issued by insurance companies. Because, I know you know this, Jimmy, but just in case your listeners don't know, it makes sense that insurance companies often sell annuities because that's kind of like the mirror image of a life insurance policy. So with a life insurance policy, you're making a stream of small payments to then get one big lump sum when you die. When you do an annuity, it's the opposite. You give them a big lump sum, and then they make small payments to you over time until you die. So, so it makes sense that an insurance company could just match those two things and just mirror them based on, where you are in your life cycle and whether you want to have a life insurance protection or if you want income because it's, near the end of your life and you want an annuity. So that's why it makes sense the insurance company has both. And so what Stockman is saying is that Hank Paulson, when he wanted to get Congress to go ahead with the TARP and all that stuff, and when the Fed wanted to justify what it was doing with AIG, he was trying to scare people into saying, look, we can't let AIG go down because it's a big insurance company, and it's not just life insurance, but look at all these annuities and whatever, and so all these retired people would get wiped out. And Stockman was saying, no, that's just totally wrong. Either Paulson was completely incompetent or a liar or both. And he's saying that those assets and the things backing up the annuity payments and the life insurance contracts, those were all segregated and protected by state regulation. You can't, AIG couldn't get that, the parent company. Let me also just mention what he means here with this amounted to wagering insurance from the AIG holding company. And we've been throwing around this term credit default swap. Let me just make sure people get that. So there were institutions out there that had bought mortgage-backed securities. So they were like pools of little bits of mortgages all put together. And so when the real estate market crashed, a lot of homeowners stopped making mortgage payments. And so if what you had was this derivative asset that was like a little bit of the mortgage payment from 1,000 different mortgages, and now you were worried about, are some of those going to default, you'd be worried about the value of that thing. And so you could buy in protection on that, which was what a credit default swap is. So AIG was taking payments from people to then say, if your mortgage-backed security goes into default, we will make you whole. So that's what Stockman means here when he said that these big companies had bought wagering insurance from the AIG holding company. And so now the question was, if that stuff all comes due, it looks like AIG might not be able to make everybody whole. That they didn't have enough to make these payments because when they were issuing the credit default swaps, they didn't realize how vulnerable these mortgage-backed securities were to going into widespread default. So that's what he's getting at. But his point is, if they had just let nature run its course, it's these big financial institutions that loaded up on mortgage-backed securities that had bought some protection from AIG in the form of credit default swaps that would get paid. It's not, average Joe who's retired and has an annuity. He's not the guy who would have gotten hurt.
Yeah, anybody engaged in the fugazis of the CDOs would have the people to get hammered, not regular Joes.
Right.
So just thinking about that, Bob, that kind of pisses me off.
Yeah, I mean, I know we got to come back to, but everything about that whole period was so backwards. My favorite thing of telling crowds to get them to be like, what, are you kidding me? Remember, this is the whole rationale of this. Sold to the public was, we got to bail out Wall Street to keep credit flowing to Main Street, right? That was the thing that they're acting like, oh yeah, we keep your reserves parked here at the Fed, don't make loans to your customers, and we'll pay you for that. So right as they were justifying all of these huge injections of liquidity in the system on the grounds of keeping credit flowing to Main Street is right when the Fed started paying banks to not make loans to their customers. So whether that's a good policy or not, we can debate separately, but clearly the official story the public was getting was the exact opposite of what was happening.
And do you feel like if more people knew about infinite banking and that insurance contracts kind of being the bedrock of the economy, do you think they would have been less susceptible to that amount of bullshit?
Well, yeah, I think so, because if you're financially secure, you can calmly just assess the pros and cons of the argument. Whereas, if you were dependent on, if you were dependent on these Wall Street, if your 401k was down 40% at that moment, you'd be panicked and worried, and so, do what you got to do to bail out Wall Street. Whereas the people who, nope, I'm fine. They could more calmly assess the situation and I think see what was happening. So I think you're right, and that's partly why I like IBC so much, is to have people who are sort of independent insofar as that's possible, and aren't going to get sucked down, if Wall Street goes down or if there's another real estate crash, that, they have this separate source of wealth, a warehouse of wealth, as Nelson Nash calls it, to just provide that sort of security and, more sober-minded assessment of what's coming out of Washington.
Or at least we could all say, hey, we're pretty liquid right now. We're going to buy your assets that you're defaulting on for a below market price. And since we're actually free market entrepreneurs, we'll make a profit out of them. Now, thank you for your emergency and leave us alone.
Right. And that's a good point you make there, that sometimes I think people, when there's a financial crash or panic, people kind of lose sight of some facts. So it's not like the tractors all were going to disappear, or that the farmland all of a sudden was poisoned, or that, all the people who knew how to program computers all of a sudden had amnesia, that the productive infrastructure and assets of the U.S. was the same. It was just what would have happened. And, Stockman gets into this too. If they did nothing, there just would have been widespread bankruptcies. And all that means is you reassign who's the owner of what. It's not like the physical infrastructure would have been degraded. It just would have been people who thought they were really rich 6 months earlier would have realized, oh no, I'm broke. And like you say, that would have provided opportunity. The people who had been more conservative would have come in and they would have acquired assets at fire sale prices. But it's not like the assets would have disappeared physically. They just would have been transferred to different owners who had shown better wisdom during the housing bubble years.
Fascinating. Okay, so these are just kind of my own notes. I don't know if these are relevant at all, but we're going to get into some libertarian theory here now too.
Okay.
life insurance, unlike a qualified plan, it's regulated by decentralized organizations. So even if every state regulator is a moron, I would prefer 50 morons to one moron at the central bank. Or one Harvard-educated, not a moron, but maybe just an asshole. I would still prefer, you see what I'm kind of getting at about the deregulation? It's not going to guarantee you're protected, but it's a lot more protection, and it's kind of a hedge against a mutually assured financial destruction.
Yeah, I think you're right. So, and you're hitting on some good points there, that it is true that the insurance and life insurance in particular is regulated at the state level currently. I mean, there's some federal things, but it's primarily regulated at the state level. And so, yeah, it's not that I am arguing, the state regulators are really wise and federal regulators aren't. It's more like you say, this issue of the concentrating power is dangerous. It's sort of like the classical liberal explanation of why did political liberty emerge in Europe and not like in China. And the answer is not because the Europeans were just these smart guys who love liberty. It's because of just the history. There was a lot of regional fighting and the various barons and what have you, and just it was more fractured and decentralized, just vying for power. And that's why that you had all these different power structures, and then in order to attract wealthy people and whatever, they sort of had to limit their power and so on. And so the same token too, like in the United States, the virtue of federalism. It's not that, because I think the governor is a smarter guy than the U.S. president, but as you say, there's like 50 laboratories. And so if one state tries something that works, everybody can learn from the example. And if one state does something dumb, well, it limits the damage. And everybody can learn from it, and people can vote with their feet and move to the states that are more productive, have better taxes, whatever. And so you're right, that's, I think, just in general, spreading that power around and decentralizing it is safer, even holding the level of competence the same at the different levels.
And the central bankers clearly failed in 2008. And it was their policies that was supposed to be protecting people with qualified plans in the stock market. So one failure was exponential for everyone. What I love about life insurance is one central planner's failure cannot destroy me.
Right. Yeah. That's a good way of putting it. And it's funny. It's kind of like these arguments about too big to fail or whatever. And it's like, well, I'll tell you what's too big to fail is the Fed. You know what I mean? So if we're worried about these hedge funds or whatever, these investment banks getting too big, and geez, if they make the wrong decisions, everything goes down. So we got to really watch what they do and right. But yet no one applies that logic, or none of the interventionists apply that logic to the Fed, when really that's kind of the single best argument for why you shouldn't have a central bank. Is that because, if they screw up, you bring down the whole economy.
The old fatal conceit. And so then Stockman goes on. I've never heard this phrase, but this is what we've been hitting on, is these dividend stoppers. So as previously indicated, all the CDS gambling debts in question had been incurred at the holding company. That's big AIG, which is to say the upstairs half of AIG clamshell. The holding company was essentially bereft of liquidity because its assets, while massive, consisted almost entirely of illiquid private stock of the endless string of insurance subsidies AIG had acquired over decades. And then here's the fun part. And the not-so-secret reality was that invariably the insurance regulators had imposed protective barriers or dividend stoppers to protect policyholders from capital depletion by parent company stockholders. This meant that in the event of bankruptcy, there would be no raid on the insurance company's assets to satisfy holding company's liabilities. It also meant there would be no contagion. That is, the AIG holding company was in no position to engage in the fire sale of insurance subsidiary assets in order to satisfy the margin calls and loss claims of the CDS policies issued by the holding company.
Right. So, there's a lot there, but let me just paraphrase what he's saying. So again, he's saying that the reason what he calls the upstairs, the parent company or the holding company, the reason they got in trouble was they had issued all of these credit default swaps. That's what CDS stands for. And so that was, they were telling other people, if your mortgage-backed securities, go into default, then, we're going to make you whole. That's what these credits, and in exchange, they were getting paid for that. They didn't just do that for free. And then he's saying now AIG's holding company, it did have a lot of assets on its balance sheet, but they consisted of the stock of their subsidiary insurance companies. And so the stock per se, that's an illiquid thing. And so he was saying you might have been concerned that they would say, okay, well, since we kind of own these insurance companies, we own the stock, so we own them, we'll just go and get the actual liquid assets of the insurance companies, like what's on their balance sheets. But he was saying, no, that you weren't allowed to do that. There was these protective barriers. And so the policy holders of those subsidiary insurance companies, they could rest assured that the state regulations prevented that holding company to come in and raid their funds. And now because of that, he's saying that's what nips this so-called contagion in the bud, kind of going back to our earlier discussion about what happened with these other companies, is because if they didn't have that protective shell, the parent company or the holding company could have grabbed whatever those assets were, like who knows what, commercial real estate or treasuries or whatever, and then started massive selling those things in order to raise money to pay off, the people they owed money to, and then that would have made another set of assets start going down more in value. But he's saying that wouldn't have happened. It would have just stopped right there because they didn't have access to those other assets to be able to start fire selling them.
So let's say I bought the put against these CDOs and AIG owned the put or sold me the put, basically sold me the insurance for these CDOs, right?
Mm-hmm.
And they stiff me. So I want to exercise my put. I want to say, hey, these mortgage-backed securities are garbage. You owe me money. And AIG would have said, I can't pay you. And then I would have said, well, I want some of these insurance contracts. And then the dividend stoppers would have said, no, you can't have those. How would I have been compensated from the holding company?
Well, it would have just gone into bankruptcy. And so then, you would have lined up with all the other creditors, and the bankruptcy judge, I guess, would evaluate, and figure out what priority do you fall into, because in other words, AIG, the parent, the holding company, didn't have enough assets to pay all of its debtors, and so that would have just gone to bankruptcy court, and they would have figured out whatever they had. So you may have ended up with, like, maybe they would have said, okay, they would have assigned you. I'm just speculating here. I don't know exactly, but it's conceivable they would have assigned you the stock of those insurance companies. And says, okay, well, what AIG's assets are the stock of these subsidiary. So here you go. So now you own 35% of this insurance company, but you would not then have been able to say, oh, okay, well, let me see, what do they got here? Oh, I'll take that commercial real estate building. I'll take those treasury. No, the state regulators would have said, no, just because you own the stock, you don't get to raid the assets. We protect those for the interest of the policyholder. So I
would have been okay. It would have been a cash flowing asset, and I could sell that stock off to somebody else to get my cash, right?
Oh yeah, sure.
But the only people who would have got hurt were the people who deserved to get hurt. The holding company that should not have been selling these puts on CDOs.
Yeah, I mean, certainly, yeah. The people who owned the shares of the AIG holding company, those the equity holders there would have been wiped out, right? Because if the thing's bankrupt, there's no equity. So
right.
Yeah, they would have gotten wiped out, and also probably there wouldn't have been enough to go around, like the share prices perhaps of those stock insurance companies. The share prices probably would have gone down. So that's why the holding company couldn't, because if they could have just sold off those stocks to raise enough money to make everybody whole, they could have done that. So presumably you would not have gotten paid 100 cents on the dollar if you were one of these counterparties. But Stockman's point is, it's not, the average retired firefighter who's sitting on $1 million worth of credit default swaps issued by AIG. These are other big investment banks and things like that. Some of them, or actually many of them being around the world, not even U.S. companies, who were the ones who, had boatload, had a big exposure to the U.S. real estate market, and then when they wanted to start hedging, had started buying credit default swaps to kind of hedge their position. they would have been the ones that, oh, wait a minute, we thought we were protected, but we really weren't because AIG folded. But it's, so yeah, the losses would have been shared among these big players. The average people who just had life insurance contracts or annuities, they wouldn't have been touched by this.
Fascinating. And then to end the matter, I think what you just kind of said, the insureds, the giant global banks would have been flat out stiffed and would have surveyed severe losses on the value of their CDS contracts. That would have been the end of the matter on an honest resolution under law and the rules of the free market.
Right, exactly. So again, just to make sure people aren't getting lost, maybe you're Deutsche Bank, and when the U.S. real estate market was hopping, was really hot, like in 2004 and 5, you started loading up on mortgage-backed securities, and these things were rated AAA or whatever, and you're, oh, this is great. I got little bits of mortgages from all over the U.S., so even if the Miami market tanks, I'm fine because I got stuff, in San Francisco and Phoenix and whatever, so I'm fine. But then the whole U.S. real estate market starts tanking a few years later, and you're in trouble. So AIG says, oh, we'll sell you basically an insurance contract. If your mortgage-backed securities tank, we'll make you whole, and you just pay us a certain amount. And so Deutsche Bank loads up on those things, thinking, okay, we've locked in some coverage here, some protection. And then it turns out AIG overpromised, and they don't have the money. So Stockman's point is, who gets hurt there? Well, Deutsche Bank gets hurt. That they thought they had, $100 million coming in to cover them, and now they only get $30 million coming in. So they just got to eat that $70 million loss. But it's not like the average life insurance guy in the United States is going to get hit from that. Another thing, too, in all this is it turns out those CDS contract, or I should say rather, the evaluations given to a lot of those mortgage-backed securities ended up in retrospect not being that bad. So in other words, it wasn't so much that the people this is what made like Lehman go down, because they also got into trouble with this stuff. It's not that the underlying computer models and whatever were that far off in terms of the rates of bankruptcy or whatever. It was more that the counterparties got nervous and made collateral requests that they were allowed to do contractually that then Lehman couldn't satisfy. So it's funny that it actually wasn't even so much that these underlying models were that far off when they were making projections and assigning risk profiles and whatever. It's just that the counterparties, when things got a lot worse than they thought, they started asking for collateral, and that's what pushed these companies over the edge. Awesome.
Well, Bob, I appreciate your time, and I know you don't like endorsing a lot of things, but I'll pop off and say it. Sometimes I lose a little sleep about what happens in the next financial downturn. But the fact that I have a bunch of liquidity inside these life insurance policies, I got a dividend stopper on my side now. I don't have any money in a qualified plan. I sleep a little better at night.
Oh, yeah, and me too. Like, that's the thing, with teaching the public about IBC, the infinite banking concept that Nelson Nash talks about, that, yeah, I mean, you're pushing people to consider something that's extremely conservative. I mean, life insurance is very conservative.
You see, you got to stop using that word, I think. It's not conservative. It's radical.
Well,
it's like calling you and me conservatives just because we think human beings trading with each other are, that we believe in the free market. That's not conservative anymore. We're the crazy radicals.
Yes, but conservative in the sense that it's not taking on a lot of risk. So
we need to strike that word from libertarian vocabulary.
Okay.
What you're preaching is radical. You're telling everybody to not do what everybody is telling them to do, which is invest in their 401k, work 9 to 5, pay your taxes.
Right.
Whatever you want to call that, the myth of the middle class.
Well, yeah. So conservative not meaning in line with what received conventional opinion says. Conservative meaning very safe compared to what everybody else is doing.
Not taking crazy risks.
Yes.
And so I appreciate your time, and I can't thank you enough for all the stuff that you've taught me. And if you guys want to find out more from Bob, his blog, Free Advice, is awesome. I refer everybody to Laura Murphy podcast if they're curious at all about the life insurance. And then if you want to learn basic economics, the Contra Krugman podcast, I think, does a phenomenal job in relevant real-life events. Because you guys basically share – Paul Krugman is the greatest preacher of the moochers and looters ever. He's like that guy on the Fountainhead. Anyway, he's putting out crap every week, and you guys are hammering him and teaching basic economic theory. Like, I feel like I could go audit any master's course in economics, and I've learned all this while lifting weights and running and listening to your guys' podcast.
Well, thanks for the kind words. So, yes, people who are interested in, the Lara Murphy report, and there, that's the last name Lara, Lara, for my co-author, Carlos Lara. That's more like financial economics, things like that. And Contra Krugman, as you say, Jimmy, is we just take on Paul Krugman's op-ed every week. And so whatever Krugman talks about, sometimes we agree with him, but usually we disagree because he's talking about why the government needs to spend more money.
Well, I remember, he is Ellsworth Toohey. He is intentionally misleading people. So I appreciate your time and everything, Bob. Thank you.
Okay, thanks for having me, Jimmy.
So I'll cut it.